Okay, fun seekers, are you ready? Yeah, we're going to try to do that which is not able to be done, but we'll do our best. Because we're going to try to get our arms around this huge monster that is the mutual fund industry and take a look at the various categories of mutual funds, different types of mutual funds. Now, folks, we are just scratching the surface. We are just going to look at the most coarse, the overarching categories, because there are subcategories and subcategories and subcategories. Yeah, remember, there's 12,000 of the darn things. Now, what I want you to do is go to the website or Canvas and download the mutual fund type Scramble sheet. Because it's a little tricky, folks. There's a lot in this one presentation that we need to get our arms around. So there's a commentary also for that. But here it is, folks. I did my best to try to show you the various types and their interrelationships. And, I'm not very good with this graphic software, so I had to write in some of the things. My apologies. But we'll go through this and in 60 minutes or less. Okay, I'm going to time myself here. We're going to go from the most risky stocks, the riskiest stocks, to the least risky stocks, the least riskiest stocks. And so the most risky funds, most risky mutual funds to the least risky mutual funds. My apologies. And the first category are the stock funds. The most riskiest are stock funds. But I guess you can buy mutual funds that are kind of like cryptocurrencies. Later. Anyway, so I don't know if this analogy is going to help, but we're going to try to think of it like a buffet table, because I love to eat. And when you go to the buffet table, do you load up your plate with jalapeno peppers or what the most spiciest, hottest spices are there? No, you put a little bit. And so these first two categories are a little bit of your food for your 401k or whatever. And the most aggressive that we're going to discuss are the aggressive growth funds. These are highly speculative. And what do we know about the word speculative? Yeah, it means gambling. Mutual funds that seek large profits from capital gains. They're rolling the dice, folks. They're trying to create eye-popping returns. And you know what? They might just do very well for themselves, or they might fall flat on their faces. It's a dual-edged sword. Do you want to eat well or do you want to sleep well? With aggressive growth funds, you ain't going to sleep very well. But that's what you know before you get in, right? You're going to be the investment guru, so you know this already. Now, believe it or not, there are one or two categories above aggressive growth. I don't know how they get away with it. They're called ultra funds or momentum funds. You can think of various names, but they're doing things that you wouldn't normally want to do in a mutual fund, like derivatives. I don't know how they get away with it, but they do. The one example that we talked about already was Janus 20. Remember Janus? Janus is the mutual fund company, and 20 was the name of the fund. What a silly name. Well, remember that a mutual fund must have at least 20 different securities, stocks or bonds or whatever. So that's the least they can have. They have to have at least 20. So here was Janus 20 saying, you know what? We're not going to have 100 or 200 stocks or bonds like, it's a stock fund. We're not going to have 200 stocks like as many mutual funds do. We're only going to have 20. I think they got up to 25 at one time. This was during the dot-com era, late 1990s, when the internet was all the rage. And it did pretty well while the music was playing, but then when the music stopped, it crashed and burned. And so Janus 20 was then buried into another mutual fund called Janus 40, burying the evidence, right? So you don't see how badly we've done in the past. What do you think of that strategy? Now, the next category are growth funds. And growth funds typically will say in their prospectus, we will be 80% invested in growth companies, whatever that means. And we'll talk about growth versus value in chapter 3 more in detail. But they typically will invest in high growth companies, and they tend to be very volatile. Not necessarily as volatile as aggressive growth funds, but some are. Some are very volatile. So this is where we want to eat well. And we're willing to have some nights where we worry about our investments, but we go to sleep and then try to forget about them and then wake up the next day and see that we've lost a lot. But don't panic, you know. And again, if you just put a little bit on your plate, it's not the end of the world. You're going to have other investments that will hold up better when the markets are falling. Okay, so you got that? Aggressive growth, and now it's going to get strange. Capital appreciation funds. What? Wait a minute, Payano. Didn't you just tell me that a growth fund was trying to grow the capital? So wouldn't that be a capital appreciation fund also? No, it's not. These are subtly different than the growth funds. These are mutual funds that seek long-term growth of capital. Okay, well, how's that differ from a growth fund, which is trying to grow the capital? Well, most growth funds have a provision that states they're going to invest primarily in growth stocks, companies that are growing. Yeah, we'll stay 80%, 100% invested in the stock market. Capital appreciation funds in their prospectus will say, well, we can be far more flexible. We don't necessarily have to buy growth companies. We might buy out of favor companies or defensive or cyclical. Chapter 3, that's the problem, right? They might buy companies that are not necessarily categorized as growth stocks if they believe there's the provision, if there's the opportunity for capital growth, for capital appreciation. You see that? So I like to think of it that they paint with a broad brush. They can go anywhere they look for growth. And in general, they tend to be as risky as growth and aggressive growth funds, but not always. You have to look at the individual fund. The well-known Fidelity Magellan Fund is a capital appreciation fund. And Peter Lynch, who we'll discuss later on, and you want to read his book, One Up on Wall Street, and the other one, Beating the Street, was the manager of the Fidelity Magellan Fund, a capital appreciation fund. He started in 1977 and retired in 1990 after 13 years of 29% a year. Right. Yeah, everybody thought the guy was a magician. Well, it turns out that he was just very good at sniffing out undervalued companies and would buy them and ride them up and then sell them. So he was very good at buying low, selling high, which is not easy to do, folks. What's low, what's high? You have to decide. And so one of his best companies that he bought was Dunkin' Donuts. Pretty wild. And then, to show you what else you're up against, one of the largest capital appreciation funds in the United States, which has been around since actually before 1973, but that's when they changed managers, so they go back to 1973, is called the Growth Fund of America. Oh, wait a minute, it's a capital appreciation fund? Yeah, and if you go to them and you say, well, Growth Fund of America, why don't you call yourself the Capital Appreciation Fund of America? They would turn around and say, excuse us? Excuse me? We were the Growth Fund of America before the industry started overlaying these names, these categories on top of us. So they'll be very indignant and say, excuse us. So that's what you're up against. And that's why you have to dig deeply into your potential mutual funds. Read everything you can about them, not just what the slick marketing material and the slick websites and the like. Read what other people say about them. We're going to look at, we're probably going to go to Morningstar and Yahoo, and there's a bunch of other websites. There's Lipper. Go to the library of all places. Yeah, I like libraries. Okay, and what did we do here? In the Scramble sheet, what I tried to do is show you aggressive growth and then wrapped capital appreciation around it. You see, I tried to do that with software. I wasn't very successful. So the aggressive growth and the growth are sort of lumped in together, and then the capital appreciation fund is there also, but sort of wrapped around because it's not really the same. Very subtle distinctions. And they're all spice, so we don't want to have all of them. Some young people might want to decide, okay, I'm just going to put $50 a month into a growth fund and forget about it. Fine. But once you get a little older, you don't want to put everything on the growth funds, the aggressive growth funds. It can burn. The next category is my favorite, growth and income. Why do we buy stocks? For potential capital appreciation, growth, and dividends. Income from stocks is dividends. So maybe they should call them growth and dividend funds? No, they don't do that. They call them growth and income funds. These are mutual funds that seek both long-term growth and current income with the primary emphasis on capital gains. And sometimes they might own bonds to augment the income if they can't really find any good companies that are paying dividends. Now, you will hear people refer to it as a blend fund, a blend of growth and income. Fine. That's fine. I like to think of these as the main entree, the pasta, the meat and potatoes, whatever is the main entree. So this is where you would put on a plate the vast majority of your investments. If you're thinking, I don't know, if you don't like that analogy, forget about it. But that's how I think about it. Think of it like a buffet, because I love to eat. And so, if an instructor on a test were to ask you what kind of fund you would like in your portfolio, growth and income is not a bad choice, especially if you're younger. Now, here's another gotcha. Some people will also call these value funds. Ugh. The problem with that is value has a different connotation often in the investment world, which we'll see later on in Chapter 3, part of the problem of doing mutual funds before we get to stocks. And so value companies tend to be companies that are out of favor with the market. So let's read value funds. Mutual funds that seek stocks that are undervalued in the market by investing in shares that have low PE multiples. What is that? Well, wait till we get to Chapter 3. Price to earnings, not physical education. And high dividend yields. So these are companies that are paying very good dividends usually, and people are not too excited about them, out of favor. So be careful, because people will sometimes lump the growth and income funds in with value funds. And they're typically, unless we know better, not the same. But in the Scramble sheet, yeah, here we are at the growth and income, and we see value or blend wrapped around it. All right. Now, here comes another one of my favorite categories called equity income, especially when you get older. Because equity income funds, now, what a dumb name. If they would have asked me, and they wouldn't. What is equity? Equity is a fancy word for stocks, right? Ownership. Income from stocks is from dividends. So why don't they call them stock dividend funds? People, why not? They don't. They call them equity income, and that's why you're going to study and be the investment guru for your friends and family and coworkers. And these are for people who do want stocks, but don't want the riskiest stocks. These are mutual funds that emphasize current income and capital preservation. See, that's the first time we've used the word preservation, isn't it? By investing primarily in high-yielding, income-producing common stocks, railroads, foods, utilities, real estate investment trusts, which are real estate companies, basically, that spin off the rent to the shareholders. Boring! But hey, boring is good in the industry. And they will often also invest in bonds sometimes to generate income when the investment advisor believes that the stock prices have risen to levels that threaten preservation of capital. So where are these on our buffet? This is the oatmeal. You're right. The salad, the boring stuff. But hey, oatmeal's good for you. Didn't your mama tell you that? Look what it does for horses, right? And what happened, folks, in the late 1990s, when the internet was raging and it was the new economy and the old economy companies, like railroads were old economy, equity income funds just lagged badly. And people thought, oh, they're all washed up. Well, guess what? When the internet bubble burst, and instead of the .com bubble, it was the .bomb bubble that had burst, these things did really well. Why? Because all of a sudden people looked around and said, you know what? Railroads are going to be around for a while, aren't they? And so they actually, some of them went up during the downturn. Right. How did they do in 2008? Well, they got clobbered too. But where an aggressive growth fund might have lost 60, 70%, a growth fund 50%, a growth in income 40%, they lost 30%. You see the difference? You see the difference? You're going to lose some money if you invest in stocks. But depending on what type of stocks, you might not lose as much as some other individuals. And I'm a big fan of equity income, especially when people get into their late 40s, 50s, 60s, and beyond, because you do want to have some growth fund. You want to have some growth even when you're in retirement. And we'll discuss that later on, but people are just living far longer in retirement. Okay, so that was our spectrum from the riskiest, the most risky, to the least risky. Okay, well, now we're going to overlay 2 more categories on top of that to make it more difficult. We're going to classify mutual funds whether they are large cap, mid cap, small cap. It's an abbreviation for the word capitalization, which we'll learn about in chapter 3. But it's basically saying how big is the company. Large caps are the papa bears, mid caps are the mama bears, and the small caps are the baby bears. And there's even a few categories. They break up these categories into more, but that's all right. That's all we need to know for now. And what do you think is the riskiest? Well, think about it. Yeah, small companies, right? Because they don't have their roots deep in the economy like many of the large companies do. And of course, medium size is somewhere in between. However, coming out of a recession, small companies tend to do really well. Why? Because first of all, they were beaten down more than the others. Plus, they're more nimble. They can react to market changes quicker than their large company counterparts. And then another category we worry about is the domesticity, which is a fancy word for where do you get your mail? Where are your headquarters? And we talked about this. We discussed this in chapter 1, right? Domestic means inside the United States. International, also called foreign, also called overseas, is outside the United States, and global means everybody, todo el mundo. And we talked about the riskiness of each. 100 years ago, 50 years ago, the domestic funds were the least risky, domestic companies. And outside the United States, international funds were the most risky. And global was somewhere in between because we're mixing the two. But this is not true anymore, folks. It's just not true anymore. Countries all around the world have seen that, capitalism might just be the worst possible economic system ever developed, except for all the others. And so they have much better accounting rules. Some have better accounting rules in the United States. But there's always exceptions, right? So what are we going to do with these categories? Well, we're going to pick one from column A, one from column B, and one from column C. And so we have a global large cap growth fund, or maybe a domestic small cap aggressive growth fund. Have you ever taken statistics and learned about permutations and combinations? The the number of permutations and combinations, 5 things taken 3 at a time, it boggles the imagination. And that's why we see 12,000 mutual funds. Because if one company has a global large cap growth fund, then they all have to have a global large cap growth fund. And there's a company called Morningstar, which you might use which I hope you do in your assignment for chapter 2, that sort of promulgated this, and we'll see how they did it at the end of this presentation. There are also regional funds, which why do we want a mutual fund? For diversification. Why invest just in Japan or the Far East or Latin America? Well, again, it's kind of like the spice. If you know something, that maybe you work in Latin America and you see it's booming. Mexico's doing really well. Brazil's trying to come back after a big boom and then a big bust. Argentina's trying to come back. So maybe you're saying, hey, things are turning around. So put 5, 10%, maybe 20% of your portfolio into one of these funds. There used to be a fund. I haven't found any record of it, but I remember it. It was a fund that just invested in companies in California. Well, California is what, the 5th or 6th largest? Or depends on how you categorize it. But it's one of the largest economies in the world. So sure, but why? We like diversification. Folks, I am a big still fan of global funds, global investing. The last 10, 15 years, yeah, about that, the domestic stocks and domestic mutual funds that invest in stocks have just clobbered global and international. I don't know if that's going to continue. I don't think it is. It doesn't mean it won't. That's the future. So I still recommend thinking global. But, it's mix and match. Now, would you invest in an emerging markets fund? Well, that's where the growth is, folks. That's where the dynamism is in the world economy. But at the same time, they have not done very well since the Great Recession, since the global financial crisis. Interestingly, though, if you go 50 years before that, maybe back 40 years before that, to the 70s and 80s, they just tore up the world with tremendous volatility, sometimes called submerging markets. There's a wonderful story about a fund that was created in the 1980s by the World Bank, the IMF, and they wanted to call it the Third World Fund. And this one very big Mahatma said, "Look, they're showing their idea to all these money managers." He said, "Look, I have no intention. I don't want to lose money for my clients, but for God's sake, don't call it the Third World Fund." And that's where they started calling it developing markets, emerging markets. Yeah, I think that was a good idea. Very good advice, and he didn't charge anything for it. And then there are sector funds: energy, technology, healthcare, wireless, leisure, different materials. These are mutual funds that invest just in one sector of the economy. Fidelity is famous for this. Folks, again, diversification. I want to own everybody. I want to buy the best companies in all the different parts of the economy, all the different sectors and industries. So if you work in the industry, say you work in the energy sector and you see it's booming, maybe put a little bit, but I wouldn't put everything on there. Certainly not everything, not even more than 20%. And if anybody tries to sell you a market timing fund, you just tell them, no, thank you. There's a wonderful saying we'll come back to. Don't try to time the market. It can only be done by liars. One of the most famous investors of the mid-20th century. Yeah, okay? So those were the stock funds. Now we're going to trundle on over to the other side of the scramble sheet and look at bonds. Obviously, bonds are going to be less risky. They're not going to return as much. Why? Because we're not owners, we're loaners. And we also call these fixed income funds because we call bonds fixed income investments. These are mutual funds that invest in various kinds and grades of bonds with income as the primary objective. And we'll do the same thing. We'll go from the riskiest to the least risky. The most riskiest bond funds are called high yield bond funds, but that's not what people call them when they're not, on the literature. They're junk bonds, right? They're called junk bond funds, and we'll discuss junk bonds in detail when we get to bonds. These things actually act more like a stock fund than a bond fund. Not quite like a stock fund, but similarly, because the high yield bonds in the portfolio will often move the way stocks move. If the economy is doing well, stocks are going to do well, and the high yield bonds should do well because these companies are banking on a good economy to get them through. They're paying much higher interest rates. They don't have the best quality of credit, just like some people don't have very good credit. Some companies don't have very good credit. So again, this is something you might want a little bit on your plate. I would not put a whole lot because when stocks fall, they're going to fall. The other bond funds are typically going to do what the opposite of the stock market does. Bonds tend to move in opposite directions of the stock. Not always. 2022, everybody fell down, but the next category are the corporate bond funds, and these are bond funds that have high quality bonds in their portfolio from very tried and true companies. There's a rating system, like our credit score for our individuals. There's a credit rating for bonds, and they will typically be high grade bonds. Some will be convertible bonds, which sounds exciting, but no. We'll talk about convertible securities later on. It sounds exciting, but it really isn't. The next category are muni bonds, municipal bonds, and some are insured, which is very cool. But what do you think? Right, if it's insured, you're going to get paid less. These are very popular with high net worth individuals. And why is that? Very simple. They don't pay taxes on the income, on the interest. And so what happens is the higher the tax bracket you're in, the more the municipal bonds are worth. So for us working grunts, we're better off with a corporate bond paying the taxes. But for people, and we're talking about people who are making $500,000-$600,000, folks, or upwards of that, then muni bonds become very popular. And muni bond funds, which own the municipal bonds, become very popular. And if you buy a state-specific municipal bond fund and you live in that state, the state will allow you to waive, WAIVE, the interest income tax, because they want to promote their bonds in their state. So if we here in California, if we buy a state-specific California municipal bond, and you're going to see these as you trundle on through the various mutual fund websites, you're going to see these California muni bond funds. I think Fidelity has like 3 of them or so. And they become very popular once your income gets very high. The last category are the U.S.-backed and the U.S. government bonds. Now, we lump them together, although they're not supposed to be, but they are. And why is that? Well, many years ago, the Congress spun off these 2 companies, Fannie Mae and Freddie Mac. I forget their actual names, but that's what everyone calls them. And no, they're not candy companies or a burger company. They are companies that provide liquidity, fancy word for money, to the mortgage market. And so the Congress wanted these entities out there to promote home ownership, but they jumped up and down and screamed and hollered and said, no, we're not going to backstop these guys. If they're private enterprises now, if they fall on hard times, well, too bad. The implicit guarantee was always thought of in the marketplace, people who bought these bonds. And indeed, when 2008 hit like a bolt of lightning from the sky, these companies were put into receivership by the U.S. government. You are now proud owners, U.S. taxpayers and citizens, of Fannie Mae and Freddie Mac. And believe it or not, they're generating billions of dollars for the Treasury every year. But you know what? We don't really like the idea of having the government in private enterprise, right? That's socialism. So everybody says, we got to somehow extricate Fannie and Freddie from the government, but nobody can agree on how to do it. And if this intrigues you, folks, if you're into politics and economics and investing, just type in to any search engine, Fannie Mae, how are we going to extricate them from the government? Or what are the plans? What are the plans for Fannie Mae and Freddie Mac? Because there are various propositions, various proposals, but we can't agree on it yet. We'll find out. Now, along with them are U.S. government bonds, U.S. Treasury bonds. And don't let anybody tell you that the United States government is going bankrupt. It's not. We have serious issues. Don't you believe that our taxes are going to have to go up and we're going to have to cut funding? I mean, cut expenses. Obviously, everybody believes. Well, a lot of people just say we can do it by cutting expenses, and that's not true. We're going to have to raise taxes. And if you want to get mad at me. But there's no other way to do it. There is a political football about, let's just default. No, don't even go there. Don't even think about it. It is too horrible a thought. But who knows, it would be like dropping in a nuclear device in the global economy if we did that. Unbelievable. Don't even think about it. The cool thing about government bonds is the income is free from state and local taxes. Well, that makes sense, right? Muni bonds are free from federal taxes. Treasury bonds are free from state and local taxes. The feds can't tax the state and local governments. The state and local governments can't tax the feds. Very simple. Okay, so we've gone from the most riskiest bond funds to the least riskiest bond funds. What are we going to do now? Well, just like stocks, we're going to overlay two more categories on top of that. We're going to overlay when the bonds mature and the domesticity. Now, when the bonds mature, a little tricky, but when you think about it, it makes sense. Long-term, intermediate term, and short-term. Remember, long-term, 7, 10, 20, 30 years. Intermediate term, 3, 4, 5 years. Short-term, 1 or 2 years. Which one do you think is the riskiest? Turns out that long-term bond funds are riskier than intermediate term, which are riskier than short-term. Now, why is that? It makes sense when you think about it. The longer the money is out there, right, the more chance for things to go wrong. The longer the money is out there, the more we investors are going to ask for higher interest rates. So we'll discuss the relationship of interest rates and bond prices when we get to bonds. But yes, don't get fooled. L large, L long, S short, S small. No. They're not the same. Mid and intermediate. No, they have nothing to do with small cap, mid cap, large cap of the stock funds. And then the global, domestic, global, international is the same idea. Domestic, United States, international, outside the United States, global, everything. So again, we do the exact same thing. We have a domestic, long-term, high-yield junk bond fund. Or we have a global, short-term, corporate bond fund, whatever they are. You come up with the permutation of your choice. Okay, now, another category, which has actually been around a long time, folks, are balance funds. And balance funds are very cool, especially when you get to be older, but you still want some stock investing. Or you have somebody who's terrified of the stock market. You say, okay, we're going to offer you or show you a balance fund. It's going to contain stocks and bonds. And the objective is to generate a balanced return of both current income and long-term capital gains. Now, theoretically, these things should be less risky than stock bonds or bond funds. Huh? I mean, you got something that's very risky with stocks and something that's a whole lot riskier with bonds. You mix the two, shouldn't you get something in between? Well, in practice, that often is what happens. But theoretically, the balance fund should exhibit less volatility. And why is that? As we already made mention, stocks go up, bonds tend to go down or stay the same. Stocks go down, bonds tend to go up. They are negatively correlated. And don't worry about that. We'll come back to that later on. That's going to be on a test, but not the first test. It's going to be on a later test. Yeah, we want to see something that's going to help us smooth out the peaks and troughs of the marketplace, and balance funds can do that. Now, some tend to be more risky than bond funds, but not all. And what they normally do, a well-balanced fund, will stay about 60-40, and there's a reason for this that we'll discuss later. I love the prospectus of the American Balance Fund, which has been around in one form or another since, I think, 1937. States that the fund is managed as a complete U.S. investment program of a prudent investor. What a great line, isn't it? I love the word prudent investor. So yeah, you want to have some stocks for growth, and you want to have some bonds for stability and income. Notice that the American Balance Fund, and other funds are like this, will never have more than 75% stocks and 25% bonds, and will never have less than 50% stocks or 50% bonds. So they keep the balance. Cool? Yeah, I'm a big fan of balance funds, especially as you get older, or for people who are just straight out terrified of the stock market. Now, careful. There's another category called asset allocation funds, which are associated with balance funds, but they are not the same. They might have names like strategic or tactical in their names. And what they're trying to do is they're trying to fine tune the allocation of stocks, bonds, and cash. Whereas the balanced fund is usually going to stay around 60-40. An asset allocation fund might try to move money into cash when they thought the market might fall. This is, in my humble opinion, this is market timing. Maybe they don't say it's market timing, but it is. And I was very pleased in 2002 at the end when we had gone through 3 years of down markets. The representatives from Nationwide on your backside were talking about their asset allocation fund and that they were 100% in cash. And that to me was like music to my ears. Oh, because these guys were goofballs. I'm sure the people running the fund were goofballs. That is the worst time to be 100% cash after 3 years of down. Yeah, you might go down some more. And in fact, actually they hit it right on the money. It was right at the end of 2002 when I think October. Then it went down again in March. It hit another low in March. But still, we were near the bottom. And sure enough, boom. So they were out of everything. They didn't have any bonds. They didn't have any stocks. The worst possible time to be out of the market. So I would stay far away from these strategic allocation or asset allocation or tactical allocation funds, in my humble opinion. Now, the last category, the least riskiest, are money market mutual funds. And we've already discussed these in detail in Chapter 1. They invest in those short-term money market instruments like corporate paper, treasury bills, bankers' acceptance notes. The difference is, unlike the ones at the banks, the money and credit unions, they are not guaranteed, but they're pretty darn close. We already talked about this. There are some that invest just in treasury bills, or some that invest in treasury bills, commercial paper, and bankers' acceptance notes. And some that are tax exempt will invest in very short-term municipal securities, municipal bonds. So as a bond gets closer and closer to its maturity date, it starts to look like a treasury bill. It starts to look like corporate paper. They are essentially as safe as guaranteed money market accounts since they invest in exactly the same securities, but they are not guaranteed. Did we mention that? Or I think we did. Research Breaking the Buck. For those of you who are interested, it's a great story, especially in 2008 when the wheels of the economy fell off and we were literally looking at the abyss, folks. It could have turned out a whole lot worse. It didn't turn out very well for a lot of people. They lost their homes, they lost their jobs, went through bankruptcies, foreclosures. It was not pretty, but it could have been a whole lot worse. It could have been a whole lot worse. I remember hearing a bond professional, a money manager from a bond fund, saying the market is frozen. It's literally frozen. And that's a scary thought. I mean, the stock market is very important, but the bond market is even more important, because if you can't borrow money, that's a bad thing to happen to a modern economy. And luckily, we got it through it, folks. We got to give them some. I do. I think we should give the credit to the Treasury, Hank Paulson, and then who took over from him, and Ben Bernanke, and what was the other guy? Oh, I can't remember the other guy's name. My apologies. But then eventually, not Janet. Oh my goodness, the woman who took over from Ben Bernanke, and now Jerome Powell. Janet Yellen. I think they've done a good job. And of course, they don't get any credit whatsoever, because nobody's ever happy with them unless it affected them personally. But it did, in a very oblique way, in a very a strong way. It did affect everyone. Okay, now. You knew it had to happen, right? Mutual funds of mutual funds. What? You're kidding, right? No, actually, these are very important. Your assignment is to research the thrift savings plan. And in the thrift savings plan, they will have these mutual funds of mutual funds. And they go by various names. The thrift saving plan calls them the lifestyle funds. Other people call them target date funds or target risk funds. You choose a fund that matches your time horizon. You need money by 2030 for your kid. Or retirement. You're going to retire in 2050. And the company will then populate the mutual fund with other mutual funds to match the time horizon. Usually with the same company's mutual fund choices, right? They'll use their own mutual funds. And that's the Z shares we talked about in the last presentation from T. Rowe Price. They don't have any fees. The target date fund has the fees. As the time horizon shortens, the mutual fund will change the mix of mutual funds. It's called the glide path. So they'll go from the riskiest funds to the least riskiest funds as you get older. You choose your risk tolerance, they choose the funds. And these things are very popular with employer-sponsored retirement plans. Why? Because people start off at a company and now they will automatically start taking 5% or 3% or whatever of your salary and sending it to the retirement plan. But before the Congress gave them permission, they did not want to get sued, and so they would put it in the money market. They would also often have a fund called the stable fund. Right. It's not going to lose money, but if you're 23 years old or 26 years old, you shouldn't have your money that you're going to have for retirement. You don't want it in short-term investments. It's just not very smart. Remember opportunity cost? But the companies were afraid to get sued because if you recommend an investment and the investor comes back and says that was a bad investment, they can sue you. Yeah, and maybe win. So the Congress said, okay, what we're going to do is we're going to have a hold harmless agreement. If you have these target date funds, you know the birthday of your employee. If you put them in the retirement fund that matches their probable retirement age, 65 or whatever, then they can't sue you. So these things became very, very popular. Cool? So let us review quickly the idea of risk versus return. The full spectrum is identified. Well, almost the full spectrum. We stay away from the ultra funds, okay? From the riskiest stock funds down through the bond funds and a little detour in the balance funds to the money market. And here's the dynamic, folks. You're at the meeting where the people in the beautiful blue suits or whatever are going to tell you how wonderful their 401k plan is. And somebody is looking at the list of mutual funds and they see this aggressive growth fund. And wow, it's got 10-year returns that are just eye-popping. And so what do? They put everything on their plate. They put everything in the aggressive growth fund, only to watch the market fall 40, 50% and their fund fall 70%. And what do? They find out, where can I not lose money? Oh, the money market. So they take what's left, put it in the money market, only to see the stock market zoom 60% up over 2 years. And then they go, oh, maybe I should put it back in the aggressive growth fund. Oh, yeah. You see what emotions can do for us? Or the person is so worried about the stock market with good reason that they're 23 years old or 25 years old. They put everything in the money market, the stable fund or whatever, the guaranteed income fund. That's a bad choice also. So what we try to get people to do is think about the middle road. That's why we call growth and income the meat and potatoes. And if they're really terrified, maybe an equity income or a balance fund, depending on their age and their tolerance. See, the problem is some people will say, oh yeah, I'm in it for the long term. And then the first sign, it fell 5%. What do you think I should do? Like, hey, buy more if you really believe in this company or this mutual fund. So that's the dynamic that we're trying to get you to see before it happens to you. Because it's going to happen, folks. There's going to be a market downturn. I don't know when. And how you react is going to tell a whole lot about how well you'll do over the long term. Yeah. Slide 52. Now, specialty funds. Again, stay away from these things, folks. They're not for the vast majority of us. There are hedge funds that they're not mutual funds. They're totally different than mutual funds. Oh, they get lumped in with mutual funds. They were traditionally only open to sophisticated investors, which is a fancy word for somebody who could lose $50,000 and not be crying in their beer. But now you see them with $5,000 or $10,000. You can buy these things. There's no regulatory oversight. They can put all their money into just one stock, or they can take all their money out of the stock market, put it in pork bellies. And if any of you have seen that movie Trading Places, that's the commodity that they were joking throughout the entire movie and then orange futures. They're sky high fees and no regulation. And there are only certain times when you can take your money out. Yep. So sometimes you can see it fall, and you can't get your money out until whatever time. And by that time, it's too late. There are funds that try to make money just when the market goes down. Not a good idea. The market goes up about 3 times for every year it goes down. We don't know what it's going to do next year, but yeah, they do great when the market falls, but they do poorly when the market goes up. And then there are funds that invest in gold and other precious metals. We'll take a look at those as investment alternatives later on. Now, there are some funds that invest in real estate investment trusts only. It's a sector fund, basically, in real estate. And for those of people who want to be a landlord but don't have the money to buy investment property, you can do that through a REIT. Not a bad choice. I wouldn't put all my money there, but that's some people. And then there are these exotic funds, these boutique funds. Folks, fiction has nothing on fact. There was a fund called the Stock Car Stocks Fund. Now, what do you think they invested in? NASCAR, right? It's hard to believe, folks, but 200,000 people on a Sunday afternoon go down to the track and watch these cars go around the track at 200 miles an hour in a big oval. And of course, what do you see on the cars and on the jackets and on the hats? Right, sponsorships. And so these people, if Folgers is the official coffee of NASCAR, they're going to buy Folgers. And so this fund bought those companies that were the official sponsors of NASCAR. And then Pause Tombstone Fund. Wait, Pause was the name of the mutual fund company. Tombstone was the name of the fund. What? They're investing... tombstones, coffins, mortuaries. Well, everybody going to die, and thankfully so did the Pause Tombstone Fund. And then this one. Look, I am not making this up, folks. Type it in if you don't believe me. The Chicken Little Growth Fund for people who are afraid that the sky is falling. There are funds just for religious funds, the Timothy Fund, and then another fund for Muslims who can't invest in bonds because they pay interest, but they can invest in things that look kind of like bonds but don't actually pay interest, but they do pay interest. Yeah, the choices are endless, and so are the fees. Slide 53, socially responsible funds, which is now the term you see is ESG, environmental, social, and governance funds. And there's a whole backlash against these things, against diversity, equity, and inclusion. These mutual funds have been around for decades, folks, that actively and directly incorporate ethics and morality into the investment decisions. There have been funds for decades that have refused to invest in alcohol or tobacco, which happen to be very profitable enterprises, I might want to remind you. But then in the 1970s, it moved to pollute, build weapons, nuclear power plants, destroy the rainforests, and then on to companies that exploit labor. It's surprising that there are any companies left to invest in. But silliness aside, many socially responsible and ESG funds have done quite well for their investors. And that is, I think, everyone's different, of course, but I think it's mostly because the tech companies tend to be the ones that fit the criteria. They don't pollute. Well, now they use up a lot of electricity. They tend to treat their employees very well because they're highly skilled employees, and they don't sell alcohol or tobacco, so they've actually done pretty well. And then, this again, you can't make this stuff up. Socially irresponsible funds, possibly as a backlash to socially responsible funds and their perceived political overtones. There is a mutual fund called the Vice Fund. Oh, yeah. You guessed it. It invests in alcohol and tobacco, and they love Philip Morris and any other corporate nasties like gambling and defense firms. They've changed the name a few times, which is very strange. It's a very small fund and has high annual fees, but it's managed to keep afloat since 2002. So for those of you who are so inclined and you don't like the socially responsible funds, you can have a socially irresponsible fund. Don't do it. Slide number 55. Now, we made mention of this company called Morningstar. And Morningstar came out in the 1980s and was determined to eat Lipper's lunch. Lipper was the company that was known for investigating and researching mutual funds. And they're still around. They got bought by Reuters and then Thomson. I'm not sure who else. But both Morningstar and Lipper's materials are available for free at the library. If you go online, they're going to try to sign you up, but they give you some stuff for free. It's called the freemium model. They give you some stuff for free, and then they charge you if you want to join up. Morningstar is going to try every 5 minutes. They're going to ask you to sign up for their $20 a month or $50 a month or whatever. They created these style boxes a long time ago. So you see, they had companies, large, medium, small, and then the style, value, blend, growth. And what it did is it encouraged a lot of investors to say, well, don't I need a mutual fund for each one of the categories? And oh my goodness, this mutual fund company doesn't have one for each of the 9 categories, so I got to go find another one that does. And so they were, and even they did a mea culpa. They even said, it probably wasn't the best idea. And so what they did is they now have ownership zones, which they say are even better. No one I know uses them. I don't use them, but you decide. And if you go in the Morningstar, you can find the new ownership zones on the portfolio tab. But if you go to Yahoo, finance.yahoo.com, the Yahoo Finance, you only see the old style boxes. Interesting. It's interesting. They still have them, but they let other people use them. They're the ones who have the ownership zones. They basically just draw a little oval around here. That's all basically what the ownership zone is. You decide whether you like it or not. I don't, but I'm a little bit of opinionated against them because I'm kind of angry that I think righteously that they helped promulgate this idea that you have to have one of column A, one of column B, one of column C, and that means there's going to be 9 columns and 9. And lastly, remember I told you we're just going to scratch the surface, folks? Here are Morningstar's mutual fund categories, and I forget that it's 64 or something like that. Nobody's going to try to learn all these. You need to study the ones on the mutual fund Scramble sheet. They're on the study guide. They're in the presentation. Make sure you know those major categories and realize that there are subcategories and subcategories and subcategories. And see, look at all the muni bonds. Every California, they have 2 California, Florida, Massachusetts, Minnesota, New Jersey. I don't understand why they have a Florida municipal bond, because doesn't Florida not have an income tax? I'm confused about that one. Maybe there's something, if you make over a certain amount of money, you're taxed on the income, the interest income. I don't know. But here, this is what Morningstar has done to the world. And this is why one of the reasons that there are so many different mutual funds out there, because there's just so many different categories, and then you have to diversify and differentiate yourself from other companies, because it's a very competitive marketplace. So now, what's the takeaway, folks? Go back and do this again. Study these. I know, yeah. And I hope you find that it's not difficult, this material. I think I've said this already. It's just there's an awful lot of it. And you really need to know it if you're going to be the investment guru for your friends and family and coworkers. Now, obviously, you can always look up subcategories and subcategories, but do your best to internalize, which is a fancy word for memorize or learn, the major categories. So that if somebody said, well, what is this value fund? I don't understand it. It says value fund. What does it mean? You can say, well, that's a stock fund that looks for companies that are out of favor, that are unloved by the marketplace. And sometimes people use value in a different method and manner, and you'll learn about that more when we get to chapter 3. Cool? Okay, now, in our next presentation, we're going to commit some heresy and discuss the current lively debate of active management versus passive management. Cool? Study hard, bring honor and glory to Southwestern College. Thank you so much for being in our class. And I told you it was going to be less than 60 minutes. Thank you so much for being in our class. We are so proud of you. Be awesome, dear students. We want you to be rich.